Last time I looked at a potential pitfall in the approach to measuring correlation to inform portfolio diversification. Today I turn my attention to a significantly more effective approach. I'll use the same source data as last time, and I'll therefore be able to perform a direct comparison of the results we got last time to see the improvement. Based on this new approach, you'll be significantly more equipped to make those important decisions about which components should be in your portfolio and which shouldn't. Stay tuned. So, as I said in the introduction, this week I turned my attention to a much more effective way of measuring the correlation between two assets. But as I said, I'll be using exactly the same data that I used last time, and so I'll be showing a direct comparison with the results we obtained using the less effective method. Let's make a start. So let's first take a look at the results that we obtained last time. So here we created this scatter diagram from the euro dollar and Aussie dollar price charts. And I just used 1 year worth of close prices taken every hour. And we said that the problem here was that we had no way of identifying when those two assets were moving in the same direction and when they were moving in the opposite direction. So the true objective of what we're trying to achieve isn't possible. So what technique should we use then in order to calculate the correlation in the most effective way to give us the information we need? Well, the key is to calculate the difference between successive close prices. And this, of course, tells us which direction this particular asset moved in during this 1 hour period. So here it went from 1.2209 to 1.2221. And so as you can see here, that represents a move of 0.00012. Likewise, we can do the same for the Aussie dollar by taking values from the same time period. And so what this now tells us is that euro dollar moved up this hour, whereas Aussie dollar stayed constant. Then you can see in the next hour, they both went down, then they both went down again, but then euro dollar went up and Aussie dollar went down. And it's this behaviour that we're interested in. So let's now see what happens when we plot the difference of the prices instead of the raw prices themselves. This is what we get. So just explaining this chart, as you can see, we have the cross axes here, and any values to the right of the y-axis represent those times when euro dollar increased in price during the hour. And anything to the left was when euro dollar went down in price. And then likewise, anything above the x-axis is when Aussie dollar went up in price, and then below it went down. And this gives us the information we really need. Because anything in this top right-hand quadrant here means that we have an hourly period where both assets moved in the same direction, upwards. Anything in this lower quartile that you see bottom left was where both assets moved down. And then in the other two quadrants, this represents those times when they moved in opposite directions. And this, of course, is exactly the information we need in order to inform our decisions about correlation within our portfolio. And so look what happens now when we plot a trend line or a line of best fit and calculate the R-squared value. We see it's actually much less than the value we got previously. And this is because although there is some level of correlation here, that correlation is relatively weak. And of course, in this case, it will be driven by the fact that both currency pairs have that US dollar element to them. So remembering that we got a value of 0.27 here, let's now take a look at the correlation between a number of other assets using this same technique. So here we have two Forex pairs that don't have any common component. So we have Australian dollar, New Zealand dollar, and the Euro CAD. And look at the difference that makes. Here the R squared value is just 0.009. As we can see, this is a slightly negative correlation. However, with R squared, this always gives a positive value. So it's still a good indication of what that correlation is. So these two pairs would make ideal candidates for a portfolio because of their extremely low level of correlation. However, this is what we see for the Dow Jones against the S&P 500. And this R squared value says it all. This effectively means whenever the Dow Jones goes up, so does the S&P, and when they go down, they both go down. And so these two stock indices would be terrible options to trade together in a portfolio, because the effect of that would be that they would increase the risk rather than decrease it. Now, both of these clearly come from the US economy, so we would expect this to be highly correlated. But let's now take a look at two stock indices that come from different economies. So we've got the Japanese Nikkei against the UK FTSE 100. And again, we do have a high level of correlation here, but nowhere near what we see with the US indices. And that weaker relationship is also clearly visible just by visually observing the scatter chart. Whether this is uncorrelated enough to form part of a portfolio is a matter of opinion, but I would say it would certainly be worthwhile looking for some stock indices that are even less correlated than this if you were going to consider that. And so now moving on to another chart, here we see the German DAX stock index against gold. And again, we're back to a condition of very low correlation here. And you can see that because we have almost as many points in the bottom right and top left quadrants as we do in the top right and bottom left. And so the movement seems fairly random in terms of the direction between the two. And of course, that's backed up by the R squared value of 0.01. And so again, what we have here are ideal candidates to form part of a diversified portfolio. Now, because we've been talking about correlation, it seems like the ideal opportunity to talk about how Darwinex measures correlation as part of its platform. And as you probably already know, different traders can make their trading strategies available for third-party investment. And that's done through what's known as the Darwin asset class. Now, just like we've been talking about traders making decisions about which assets should form part of their own portfolio, investors need to consider that also. And so, of course, it will be vitally important for investors to be able to see what the correlation is between different Darwins. So let me show you where you can find that information from. So after drilling down into a particular Darwin, you can come to the correlation tab here. And because we're looking at the Darwin QJU, that appears on the left-hand side of the matrix here. And then across the top are the most correlated Darwins to this particular one. And here you can see the correlation with ZPX is 0.39, likewise for BPF, and so on. Now, in the chart below, you get an indication of how the equity curve compares to the most correlated Darwin, which of course is ZPX. But in this particular case, a value of 0.39 is seen as perfectly acceptable, and so both of these Darwins are allowed to take part in the monthly Darwinia trading challenge. And this, of course, is where Darwinex invests its own capital in the best performing Darwins for the previous month. And so that's just a couple of ways there of how correlation is used. One, to help inform investors about their portfolio, and two, to allow access to the Darwinia monthly challenge. Now, of course, during this episode, I've only considered a very small number of assets and combined those to identify what the correlation is between them. In the next episode, I'm going to go big and look at the market as a whole and give you an idea of how those correlations work across the different asset classes and assets within them. Now, if that episode's already available, you'll see it top right now. Otherwise, until next time, trade safe.